Hey everybody, welcome to Finance at 15 here with Stein Wealth Advisors. I'm Joe Pizar. I'm joined with my partners Melissa and Josh Stein. Welcome guys. And we are ready to bring you some of our indices, indicators, and implications from the past quarter here in the financial markets. The point in doing this is to help you separate the data from the narrative and make good financial decisions with us, your advisory teams. Also, remember that this is not financial advice. For any specific financial advice, make sure you come in and see us. But we wanted to get into the indexes and see what happened within the various parts of the market this year.
As you look to your screen, you'll see 4 lines representing different indexes that we use to track various areas of the market. In the blue, you'll see U.S. S&P 500, which represents our larger companies, and we'll have some interesting bits about that, but that is up 14.19% so far this year. Next, we have the orange line representing non-U.S. stocks. They're up around half of that at 6.63%. Next, the green line you see is U.S. bonds, or the aggregate bond index. That came in at a negative 1.43 this year. And then lastly, we see a lot of growth concentrated in the NASDAQ, or our tech sector, which is up 28.94% this year.
So we've seen a lot of movement in the stock and bond market this year. So Josh, what's going on in the stock market that you're seeing, and what are the major indicators that are driving these markets?
Thanks, Joe. So the stock market's been a challenge this year, mostly still very much directly correlated to Fed policy and inflation. We've still been seeing a lot of the headwinds with the stock market, trying to kind of figure out what the next step is here for the Fed and what their challenges are going to be with regards to continuing to bring down inflation. With some volatile Fed policy and not necessarily having a very clear direction as to when rates will stop being increased, we've seen the 10-year Treasury yield continue to rise, and that's put a lot of downward pressure on the S&P 500 and the rest of the U.S. stock market. Although the returns year-to-date look not so bad when you look at the S&P, I think year-to-date up right now up about 13 or 14%. It's a little deceiving because almost all of the positive performance has come from just a few companies, really those tech and consumer discretionary companies, your FANG type companies. In fact, I think if you were to take out the top 10 market capitalization companies in the S&P 500, it's actually down 3% year to date. Wow. So that means 490 of the 500 stocks in the S&P 500 are down. And the same essentially could be said for the NASDAQ. We've just seen such a heavy concentration in some return from the following year, moving forward this year, that it's kind of bolstered up that S&P 500 index, which is great if you're invested in the S&P, and many of our clients have S&P like positions in there. But to look at that as an indicator from a broader U.S. perspective, not necessarily all roses. As far as fixed income goes, we still are wrestling with potentially higher interest rates. We although haven't necessarily seen the volatility that we saw last year in bonds, which I think the aggregate bond index was down close to 13% last year. I think most of that risk is gone, but we're still in a position where the bond market's trying to figure out where the plateau is for interest rates. And I think the small amount of volatility we've seen this year is just still trying to figure that out. And we're going to have a whole nother video to really talk about fixed income, because it's now such a more important asset class than it has been in a long time, because there is some yield to be had on bonds, as well as some opportunities that are coming up with the Fed potentially at some point stopping raising rates and even potentially lowering rates. That there's a lot more activity and energy around the bond market that needs to be considered and discussed. And I think for most clients, they're just really not familiar with the risks and opportunities associated with that.
Well, things have changed. I mean, since 2008 and 9, we've been in this extremely low interest rate, low inflation environment. And what that meant for bonds right before the pandemic is they were a relatively overpriced asset class paying very little. If you remember, you couldn't get any yield in a money market or a CD. In bonds, we're only paying. I mean, we were lucky if we could build a portfolio that was yielding like 2.5% to 3%, and that's a different story now. So as Josh said, there's just some different opportunities there, and in some ways, we feel like our clients can benefit from this because we can build portfolios a little differently and get a better yield on that side again. And that hasn't been an opportunity for a long time. So that's sort of one silver lining of, the bonds correcting last year and this whole sort of normalization of inflation and interest rates now.
Absolutely. And there's this whole like new carrot out there. And that carrot is 5% money market accounts, which is great and should play a role in most people's investing portfolio. That being said, there are some challenges that go into that, especially these hidden risks that are just not familiar. In particular, things like reinvestment risk and the impact of that.
And what is that, Josh? Because not everybody knows what that is.
Well, we could take way longer than
Okay, all right,
this video, but that being said, we're in what's called an inverted yield curve right now, which means we're getting rewarded for buying short-term debt. So think of things like savings accounts, CDs, bonds that have short maturities. As you go further out into the yield curve, looking at 2-year treasuries, 10-year treasuries, even longer term, 30-year bonds, you're actually getting paid less to own those. That's not typical of a normal economy. That being said, we've started to see that inversion go back, and we're just starting to see that. But when that happens, the shorter end of that yield curve, where you're getting paid 5% for a savings account, essentially the parties starts to become over, and you have to then reinvest that money at a lower rate. So what does that mean? Does that mean you buy further into the yield curve? Maybe. But the reinvestment risk piece of that is a big thing that we're starting to consider. How do we take advantage of that? How do we make sure that if and when rates start to come down, we have the opportunity both today and potentially in the future? And that takes a little bit more methodology and takes a little bit more planning to do, rather than just putting that money in the savings account or the CD, because at some point those rates will come down from where they are today. And then what do we do with that money? So
Right.
And one of
some of the major indicators today that we think are most important, I mean, we're kind of segueing right into that, are interest rates and inflation. And we want to talk a little bit about the labor and the housing market as well. But I mean, any thoughts on kind of where the Fed's headed with those? What are we thinking here?
Yeah, well, I certainly think that the Fed is closer to finishing raising rates or being done raising rates than they are from the beginning.
Sure.
Whether that's today or 3-6 months from now, nobody really knows. At some point, they will be done raising rates, and then the question is, do they stay the same, and that's kind of like a plateau, or do they start to lower and we see a decrease? And both of those Fed decisions have an impact on savings accounts, bonds, and that impact is heavily related to the liquidity, the duration of those investment pieces.
Well, and the overall economy.
Absolutely.
I mean, there is really no consensus right now about what's going to happen, and we're in uncharted territory. I mean, it looks like inflation's come down a lot, but there's some indicators showing it might be creeping back up. If that is the case, the Fed might have to keep raising. If they go too far, could they throw the economy into either a recession we shouldn't have had or a deeper one? I mean, we are at an elevated risk of a recession. We know that, although they just reduced the probability of it this morning. I think it was like over 50, it was like 54%. Now they're at 48%. That's the general consensus. And that means that things could go either way in the stock and the bond market next year. So for 2024, I mean, we do think there's a fair amount of uncertainty. So, I think this is going to continue to play out, and we're going to continue to make adjustments to that. Joe, did you want to talk a little bit about the labor market and the housing market, and then we can get into the implications of all this and some of the things, some of our asset allocation convictions?
Yeah. And that's one of the leading things that kind of drives the economy are jobs and job force participation. And we had this big disruption. I don't know if anybody remembers, there was a pandemic a couple of years ago, and everybody had to stay home for a little bit, and we had to kind of stop and restart the economy. We can argue the the methodology in that process, but what we've seen, right, with that high inflation, for whatever reason, because we spent so much money, we put so much money in the system, the M2 money supply, all that, we had that heightened inflation that got all the way up to 9%, which we have not seen since the 80s. So you had that pop to inflation, but then we saw it subside down. We this year got down close to 3.5%, kind of trickling back up there. But that coupled with the labor force having this opportunity during the pandemic has sparked some labor movement, and the middle class has been able to take ground back in their wages because of this inflation. So if inflation's running at 9 and your wages are growing at 8, you're still losing a little bit to inflation. But with wage growth staying consistent in its climb, we see with inflation down at 3, workforces are taking ground back and getting a higher standard of living for that, which does support, because what drives the economy is consumer spending, and that has remained resilient throughout this entire pandemic. But we are about, if we track this, we're about running out of COVID stimulus money. So you see people going back to the workforce, and numbers last week indicate that, right? 300,000 jobs added to non-farm payrolls, which leads us to believe that this job market is still resilient, and we're still adding jobs in this economy, which we want to see. But right, like we said, they're trying to slow the economy down into a more normalized period. So we'll see. It remains to be seen. You again see some stress in the housing market, where our inventory is now, at some very low levels, but our production of homes is now catching back up with some of the supply chain issues subsiding. But there are still some of these materials, supply chain things. But all in all, positive things for the middle class in the economy, and positive things for the corporations, because they remain strong with strong balance sheets. But it's a little bit more to lend when the interest rates are up like this. So that's kind of the canary in the coal mine if we want to watch that. And what are these corporations doing to satisfy workforce needs, get their products to market, and remain profitability, because they marked some of the record profitability.
Well, stocks go up when profitability goes up. And I think in general, most experts, economists, and money managers and investment advisors, I mean, we've all been a little surprised about the resilience of the economy, but I think the general consensus is that we're still kind of living off of the fumes of the stimulus, like whatever part of that it was. And we haven't really, we're now kind of starting to absorb all of that. And the question is like, what comes next? So we've been doing a lot of things within our portfolios in general, and just have some convictions about our asset allocation structure to help sort of best prepare our clients for what we think is coming next, which maybe we don't know exactly what's coming next, and that's okay, because there's things that we can do. Josh, you want to talk a little bit about some of those, high level decisions we've been making?
Yeah, I think we're at a really interesting part of the year right now, because the story is kind of unfolding in real time, and like Melissa said, like there's a lot of unknowns, but those unknowns will start to shake themselves out over the next several quarters. And whereas I think oftentimes we're able to predict a little bit better when you're dealing with the government and you're dealing with policymakers, it can be hard, because these aren't economic indicators. These are people in governments making decisions, like the Fed. So nobody has any idea what the Fed's going to do except for the Fed. And quite frankly, they may not even know. So with that in mind, we've really stuck to what I would call being defensive. We're keeping our chess pieces on the board, but we're not necessarily advancing, but we're not necessarily retreating either. And we're doing that in a couple different ways. One is we're taking opportunities to hedge our equity positions without deviating away from our core allocation by using strategies that can give us some downside protection. And we think that that's important, because if we take the chips off the table, we miss any potential upside. And if we stay full tilt equity, we get to experience future volatility. And so we like the opportunity to kind of maybe take a little bit of the best of both worlds without deviating too far from our core allocation. We are also increasing our bond positions relative to the alternatives that we have utilized during a rising rate environment, and cash. Reason being, many of the things we just talked about, rates are higher. A lot of the inherent risks in bonds that we saw last year have really started to shake themselves out, given the fact that the Fed is likely to be done raising rates soon. And there is some opportunity for appreciation if we can use some of the concepts I briefly discussed, meaning duration, if we can use the duration in our bonds to be in the right places, if and when the Fed lowers rates, we can actually maybe even earn back a lot of the losses that we saw from last year.
Yeah, and what Josh was talking about with duration is a lot of times, I mean, the longer term bond you own, generally the more sensitive it's going to be to changes in interest rates. So sometimes there can be some reward there if we do see rates plateau or drop. And I think that at some point in the future that's going to be inevitable, and we can take advantage of that, as well as the fact that bonds are yielding significantly more today than they were 2, 3, 4 years ago, for a long time, for really the last 15 years.
Absolutely. On the stock side, in addition to some of the equity hedging that we're trying to do, we are kind of focusing more on quality versus growth over value. So we kind of want to own the best of both, for many different reasons. But from a volatile standpoint, we think that that's very important right now. We're less encouraged to own small cap companies just with how high rates are right now, and the continued potential volatility on that side. And we are slightly increasing some of our mid cap positions for kind of middle sized companies. We're neutral on international, although we're still significantly underweight our core international percentages. We're somewhat neutral in terms of we're not raising them, we're not lowering them, we're just kind of staying where we are.
And I think it goes with saying that we're keeping our eye on the geopolitical conflicts that are going on and figuring out what those first and second layer implications will be out of these regional conflicts. But we obviously are keeping a track on Ukraine and Israel and all that's going on with these geopolitical and trade things with that. So
yeah. Mm-hmm. Big picture, we're still fully committed to a diversified portfolio. We feel very strongly that being in the right places at the right time is important. Unfortunately, we just don't know what the right time is. And so our opportunity right now is to try to take advantage of some of the small, timely, and tactical adjustments that we can make today, without fully deviating from our kind of core fundamental philosophies of how we invest clients' money.
I mean, this has been an interesting time from that standpoint. I mean, I think probably the most important thing to note, at least with our clients' portfolios, is that we have continued to and will have a need to continue to evolve how our asset allocation functions. The way stocks and bonds behave together isn't always, same way as it's been, historically. Looking for other ways to hedge risk, and in both the stock and on the bond side, when things are getting tough, and looking for more tools in our tool belt to be able to do that, more than just adjusting sort of where some of those classic asset classes are. And I really think that we can add a lot of value to the portfolios by managing those things and continuing to expand the lineup of investment options that we're offering to our clients, because it does make a big difference. And times certainly are, I don't want to say they're more complicated, but data flows and information flows faster than it ever has, and that certainly does complicate things. The good news is these are not things that are insurmountable. I mean, I think in general, when we kind of look at where I feel instinctively that a year from now, things will probably feel a little bit better than they do today. Just like they did, they feel better today than I think we did a year from now. I mean, last year, if you remember, I think S&P was down like 25-26% right around this time, right around Halloween. And we've certainly seen a nice kind of recovery from that. So, I mean, the reality is that we're long-term investors. I think that's sort of one of the hardest things too right now.
And even harder with a really attractive
I was just going to say
savings yield. And again, not to say that isn't good to have. And certainly, again, everybody should potentially have some liquid cash. But that carrot can pose some challenges. And I think we're going to have a much more thorough video about that, because it's a really new and important conversation. We're going to be hearing a lot more in the future about what's called reinvestment risk. Nobody's really talking about it yet, but it's coming.
It's that time.
Well, and we do promise that we'll keep this at 15 minutes or less, but we are going to start adding some bonus content at the end. If anyone wants to dive into some of these other subject matters, because we could talk for a really long time. But I mean, I think in general, general outlook is, we don't know what's going to happen in the timing on this one. I mean, next year we could go into a mild recession, we could go into no recession. that could have a different outlook for stocks. We don't know when the Fed's going to be done raising rates. That could change the timing of how bonds are going to behave. But the good news is that we've thought through these things and we've done things to reduce risk in the portfolio.
Absolutely.
So with that being said,
Yeah.
I think we could probably wrap up.
Yeah,
for today.
And I think one of the things that I'm excited about, guys, and we started around the same time about 15 years ago. This is our first time to practice in a normalized interest rate environment, and these types of opportunities, we've been fighting against that current. So finding people reasonable places for their cash to keep up with inflation, like we can do that, as well as run dynamic portfolios that are, allocated appropriately across asset classes, across risk parameters for exactly what that client needs. So I appreciate what you guys are doing and the time we're putting into investment committee, into doing this content for folks. And remember, we're trying to separate data from narrative. So we hope that we did that with today's video, and we hope that you took some nice ideas out of this. Please share with a friend or colleague. And if you need a second opinion on your financial situation, we're more than happy to give that to you. If you're a current client, make sure you're coming in for your review meeting so we can touch base and make sure your house is in order. Other than that, guys, anything else to add for the good of the order, or we'll see you next quarter?
I think I'd just like to remind everyone, if they have any questions, you can always email info@steinwealth.com and visit us on LinkedIn, Facebook, or our website. So thanks again for listening. We hope you found this valuable, and stay tuned if you want to look at any of our bonus content.
Thank you all.
Thanks.